Investors appear to be happy and appear to be committing more money into the market. Is there any spur that has resulted in this return to the market?
I think what happened over the last 2 weeks, local fund managers were reporting their quarterly performance to their trustees, and that had led to very slow volumes on the market over the last 2 weeks. This week, there's been a bit of a revamp on the market. The key sectors that have been on focus are the utilities. There's been a lot of interest on Kenya Power and Lighting, a lot of interest on East Africa breweries, and also on the banks, obviously, on the back of the first quarter financials. Cooperative Bank, KCB, and Equity Bank have also been topping in terms of volumes over the week.
Is there any reason why investors would be interested in the companies that are owned by the government or utilities, particularly given the ructions that we know are still rumbling in within the Kenyan political system?
Okay, I think the unique position for Kenya Power and Lighting is its role as being a distributor company in the Kenya utility sector. What happened last year is its transmission function was separated from its distribution function, which means that its capital expenditure going forward is going to be much lower and focus on improving its distribution assets. I think this company is also moving to prepaid meters, which should improve its working capital position. On a valuation basis, it's trading at less than its 2011 estimated book value, which is at about 25 shillings, and its current price is at 21 shillings. I think on a long-term basis, it definitely offers value at the current price, and that's maybe what's pushing the local investors to buy into that story.
Let's talk about the banks, because as I said in the news earlier on, we had Equity Bank coming in with results that were above market expectations. Let's begin perhaps by looking at whether they were above your expectations.
Oh yes, they were above our expectations. We had net profit of 1.9 billion. We're actually on the higher end of the curve in terms of consensus estimates. Most of the local analysts had it coming in at between 30 to 40% year on year compared to what they did, which was 80%. I think the interesting story for this bank is improving efficiencies. Its cost-to-income ratio was at 45% compared to 54% in the last quarter. That by itself is very, very impressive. Its push is to augment its IT infrastructure, to bring in personnel that understand how to use the IT infrastructure to complement its strategy in getting into the SME banking. It's also focusing on agency banking, it's focusing on mobile banking, and I think all these are quite efficient systems of delivering your products, especially for a transactional-based bank like Equity Bank. Yeah,
but at the same time, this is also a bank still very much in the expansion phase, because we're looking at a loan book growth of 45% that they are looking into for the rest of the year. Isn't that risky, particularly when you think about the fact that we've got inflation sitting at 12.1% and probably set to accelerate further, and so perhaps the central bank probably going into a tightening phase from here on?
I definitely agree with you. I mean, its growth rates are very high, but it's important to note that the kind of loans that it's been issuing have been very micro. So you find that the average size of a loan is about 50,000 shillings. So you're able to churn out excessive volumes, and your NPL risk in terms of absolute figures would probably be much less than you'd get for the banks that are focusing on the corporate and the high-end retail market. Nonetheless, the non-performing loans ratio is becoming very, very, a bit of a concern. It's currently at 3.7%. Management is attesting to the fact that they're taking in loan loss provisions through their income statement as a conservative measure, as a prudential measure to avert any instances of NPLs. But definitely NPLs will be a key focus for the bank and also for the sector this year.
Indeed. And what do you have on it? You got it as a buy, you're buying, you're selling?
We have it as a hold at a price of 26. We believe in the growth story. We just feel that the valuation is rich. But that aside, I think the financials, it was a 25% bit on our own estimates. That will definitely bring in a bit of upside next week when the market resumes operation on Tuesday.
So you probably are going to be looking at those numbers again and perhaps revising that out, that rating on the stock. But let's talk about the banking sector as a whole. I mean, we've seen results coming out of Equity. We also saw results coming out of Kenya Commercial Bank and Cooperative Bank as well. Give us an assessment, if you like, of the results and how you have viewed them from Renaissance perspective.
Okay, I think the results are very strong. There's a lot of growth in terms of lending, which means that your funded income levels are being sustained by core businesses that the banks are engaging in. First quarter, I would not use it as a read across for the rest of the year, mainly because the margins that have been reported for the first quarter have been very strong. I think the high inflation rate, the NPLs, the push by the central bank to lower lending rates will all be felt between the second and the third quarter. So I think by the time these banks actually come back and start reporting their earnings at that time, then we'll be able to see the impact of margins. But conversely, what's happening with all these banks is their cost-to-income ratios are declining, which means that they're already reporting operational efficiencies, which will be a mitigant to the scenario where you have declining net interest margins.